Most people assume their interest rate moves with the RBA cash rate, and it does, for the most part. But here's what almost nobody thinks about. Your rate wasn't just set by market conditions. It was set based on a personal risk assessment on you by your lender when you first got your loan out, and it probably hasn't been revisited since. That means that your rate right now is probably very out of date for where you are in your financial journey. Here's how bank pricing actually works. When you first applied for your loan, your lender assessed how risky you were as a borrower. The primary measure they used for this is something known as LVR, your loan to value ratio. It's basically just the amount of the loan that you take divided by the value of the property, expressed as a percentage. You might have heard of it before. At 80% LVR or above, you're seen as quite a risky borrower. Drop underneath 80% and that risk decreases. Below 70, it decreases again. As you cross from one band to a lower band, your risk assessment changes and your rate should reflect that in a positive way. Crossing from one band to a lower band could result in several tenths of percentage decrease in your rate. Think of it like car insurance. Every single year you get your insurance assessed and the insurer will look at you, look at your risk profile and make a pricing based on that. If you drove very safe throughout the year, no incidents, your pricing might go down. If you didn't, it's probably going to go the other way. Your bank did that calculation once, and they've stuck with the same pricing ever since. There's no financial incentive for the bank to voluntarily drop your rate. It's just not something that makes sense for them. But the important thing is your risk profile has almost definitely changed since day one of your loan. Two things have quietly been working in your favor since the start of that loan. The first of which is the monthly repayments that you've been making. Every month, your loan balance goes down, and as a result, your LVR becomes better and better. A lower percentage over time. If you've been paying for 3, 4, even 5 years, your loan balance has reduced significantly and your LVR along with it. The second one is property values. And this is the one people don't think about as much. It's easy to look at your loan balance and see it decreasing over time, but you don't really know what your property's worth over time, in most cases. If you bought your property 3, 4, even 5 years ago, it's likely increased in value. And that's another lever that's decreasing your LVR and making you less risky for a lender. Let's put some numbers on it. Say you bought your property for $600,000 and you borrowed $480,000 to do so. That's an LVR of 80%. Fast forward 5 years and maybe your property is now worth $750,000 and your loan has gone down to $430,000. That's an LVR of 57%. You've gone from the 80s down to the 50s. That's a big drop and your rate should reflect that as well. And your bank almost certainly hasn't updated your rate to reflect that. But at least you know now that you have the grounds to make a case for why it should be lower than it is. I want to introduce something here because it's going to be a recurring theme throughout the rest of these videos in this short series that we're sending to you, and that's equity. Most people have heard this term before, and most people think of it as a wealth number, the value of your property minus the amount you still have owing. And that's very correct, but there's more to equity than just a wealth number. Talking about pricing and rates, equity is what sits behind your LVR, and we've just learned that LVR is what sits behind your rate, which means equity isn't just a measure of what you built, it's a lever. And once you understand that, you can use it to your advantage. We're going to come back to equity in the next videos, but right now, think of it as something that you can use as a pricing tool, a bit of leverage for you to see if you can get a better deal. But it does go a lot further than that. Here's what I'd suggest doing after you finish watching this video. Pull up your most recent loan statement and get an idea of what your current balance is. You should also get an estimate of your property's value right now. You can usually find these on real estate websites, or you can check in with us and we can order a valuation for you free of charge. Then do the simple calculation. Take that loan balance, divide it by the property value, and that should be your LVR as a percentage. If that LVR has dropped significantly from day one of your loan, then that's a big deal and something worth having a conversation about. And if you want a more accurate picture of where you stand, how competitive your rate might be, please feel free to come and have a chat with us here at Swish Finance Brokers. In the next video, we want to show you something that connects directly to what we've been going over today, and that's the offset account. Most people have an offset account, most people know what it does, but so many people are leaving things on the table when it comes to their offset account. Sometimes money and sometimes potential strategy. When you understand how an offset account can work both now and into the future, you can use it as a tool. One, to better your pricing situation by improving your LVR, and also by setting you up for future strategy. And most people don't think about it, but future strategy matters more than almost anything on your loan right now today. Hopefully you have a better understanding of pricing, of risk, and why your rate might not be as competitive as your neighbor's rate might be. We look forward to seeing you in the next video. Thanks.